Alternative funding options for companies, a presentation from RiverFort Group. Disclaimer. Please review the disclaimer presented. This presentation is intended for educational purposes only and does not constitute an offer or request of investment. Introduction to RiverFort Group. The RiverFort Group is an international financial services group headquartered in London and comprising RiverFort Global Capital, an investment advisor authorised by the Financial Conduct Authority in the UK, and discretionary capital regulated vehicles that are both listed and unlisted and are advised and managed by RiverFort Global Capital. RiverFort also advises institutional and family office co-investors for direct investment opportunities. The RiverFort team has been deploying capital for over 10 years and is a large and active funder of listed companies worldwide and has funded over 100 companies to the amount of $500 million during that time period, covering an array of financial instruments including equity capital, convertible debt, and senior asset-backed debt. If one looks to the left, one can see an example of companies that have been funded by RiverFort across a variety of instruments and a variety of jurisdictions. Overview of the alternative funding marketplace. Many equity and debt financing options are available to companies. In front of you, you will see a 2x2 matrix, and on the left vertical axis, we see the range of capital deployment from small to large. On the right vertical axis, we see the holding period, which can be anywhere from 1 month to multiple years. And then in the left side of the matrix, we see equity-centric investment. And on the right side of the matrix, we see debt-centric investment. In this matrix, we can see in the lower left quadrant, we primarily have equity funding of a smaller nature. And then on the right upper quadrant, we see that it's primarily dominated by bonds, large funding amounts, multiple years, and geared towards financially mature companies. But within those two extremes, there are a variety of mixed funding solutions that service different roles between equity and debt. So as we can see, moving back from bonds, we move towards term loan, asset-backed loans, secured funding that is typically a precursor to bond finance and is secured by companies who have cash flow producing assets that they wish to scale or invest in new assets. Moving on from equity, on the other hand, we move into preferred equity. And preferred equity is a lower risk version of equity capital that confers more rights on the investor and often can attract a coupon and can be convertible into ordinary equity. And then in the middle we have mezzanine capital, which is typically intermediate financing that involves the delivery of a version of a loan to a company that is repaid by the company, but to give the investors more benefit from the performance of the company. The mezzanine capital is often associated with warrants or various forms of equity kicker or various forms of operational performance kickers like royalty finance. Within these general categories, we have a wide variety of funding instruments, and we believe it is very helpful for companies to understand these instruments and how they can be made available to them. Towards the bond end of the spectrum, we have secured term loans, we have royalty finance. On a shorter term level, we have bridge financing, which can bridge to an acquisition or a cash flow event or a placing. We have overdrafts and revolvers, which can provide capital flexibility to companies, but also can provide working capital support. And then as we move towards the mezzanine middle tier of the capital structure, we have access to convertibles, both fixed price convertibles and variable price convertibles. We also have access to various prepaid equity structures where capital can be prepaid in advance of an equity issuance event. And we have various forms of shared backed collateral, so where a company may borrow and pledge assets such as shares of subsidiaries or shares of other listed assets. And as we move more towards the pure equity end of the spectrum, we have various forms of equity structures in the preferred equity category, such as equity placing plus various forms of warrants. We have quasi-placing underwriting, where a funding structure can be implemented that can ensure a company has any capital not placed in the placing is taken up by the underwriting provider. We have tranche equity purchase, where a company can have a variety of equity purchase over a long period of time to ensure they have a monthly capital inflow. And we have equity placing sharing agreements, where equity is issued to the investor and then the company will receive proceeds from that placing based on the share price performance over a 1 or 2 year period. So there's quite a wide variety of instruments that are available to companies, and these can be used in various forms of combination as well based on the company's particular needs. Use of funds scenarios. There are two primary dimensions for use of funds when it comes to any form of capital, including structured instruments. We have the stage of the company from early stage to late stage in terms of maturity of its cash flows. And we also have a variety of specific scenarios that can be relevant to a company. So regarding the maturity stage, companies typically mature from an early stage high growth company, high risk company, towards an area where they're scaling, they've dealt with a lot of the early stage risk and they're in a high growth mode, towards ultimately maturity, where the company's products and services or assets mature and it moves into a steady state cash flow generating business. The instruments that are available to the company are essentially serve different roles with respect to the company stage in that value curve, as you can see in front of you, ranging from equity centric instruments in the earlier stage, moving through mezzanine in that high growth stage, through to senior secured funding in the mature stage, and instruments like royalty finance where it has a predictable cash flow asset over a long period of time and would prefer some kind of royalty linked funding versus senior secured traditional debt funding. Funding solutions. There are a number of scenarios in which companies will seek to access capital where structured and intermediate funding instruments are particularly relevant. The first scenario we have is acquisition financing. Often companies have an opportunity to acquire an asset, but they have a timing disconnect to raising capital, whereby either A, they do not have time to raise capital, or B, raising capital prior to the acquisition would be too dilutive. RiverFort can assist by providing bridging capital to fund the acquisition, which can then be subsequently refinanced post the acquisition by equity placing or other forms of capital. This is a very useful mechanism to give speed of action to companies and also to minimize dilution ahead of an acquisition. It's often a good policy for companies to prepare this funding option in advance so they can move with decisiveness when the opportunity arises. Going concern assistance. Companies often have a requirement to ensure they have working capital for either a 12-month or an 18-month period. And to do so will require them either to raise money now or to have confidence that they have access to capital throughout that period in a sufficiently robust manner to facilitate their working capital or operating capital requirements. RiverFort can provide 12 or 18-month funding packages that can actually provide that certainty of capital access for companies to ensure A, they can plan appropriately, confident in their access to capital, and B, that they can provide suitable confidence of capital access to their advisors and auditors to ensure that they retain their going concern status. Share placing flexibility. Markets can be open or closed through no fault of a company, where investors have appetite for their sector or not, or where macro conditions make it difficult to raise capital. Unfortunately, a company's capital expenditure may cause them to need to raise capital at the worst time given those conditions. RiverFort can provide flexible funding solutions, revolving capital, intermediate capital, that will enable a company to have more flexibility when it needs to go to market, so it can time its capital raise when the market is most receptive to its offer. Project finance is another good use case where companies need flexible capital access. Often when a new project is being commissioned or acquired, a company may be required to develop a complete and comprehensive funding package involving equity, mezzanine debt and senior long-term debt. RiverFort has the capability to provide mezzanine and senior long-term debt at the asset level to the company, and this can be combined with an equity raise. Very often it is prudent for a company to contract in the mezzanine and the long-term debt and then have that debt be released conditional upon an equity raise. This provides a greater probability of success for the equity raise, but also reduces the immediate equity requirement, thus making the project more likely to be successfully funded. Long-term equity financing. In addition, companies often need capital over a longer period of time and not immediately. RiverFort can provide funding solutions that enable a company to draw down equity capital over a 6 to 24 month period, thus ensuring the company has that continued access to capital but not diluting the company immediately so that it can benefit from future share price performance related to its activities. And finally, we have royalty financing. There are scenarios where a company does not wish to dilute its equity but has an attractive project. In these scenarios, RiverFort can provide long-term capital that is repaid through the revenue performance of the underlying asset, where RiverFort achieves principal recovery from the operating cash flows and achieves its profit not through equity performance but through a revenue share on the basis of the operational asset. Thank you for your interest in the presentation. We hope it was helpful in developing your understanding of the alternative funding environment. If you wish to contact us to discuss any specific scenarios, feel free to contact us based on the information presented.